two things usually happen. One, bearish traders start protecting their short positions. Two, breakout traders go long, expecting a breakout rally. Smart money knows this. So what do? They create what we call a buy-side delivery, a sharp, intentional move upwards designed to grab all the liquidity sitting above those highs. It looks like a breakout, but it's actually a trap. Once that liquidity is taken, smart money flips their positions and sells into the trap long.
Never drive off immediately after filling your tank. What happens in those first few minutes is losing your gas and you so fast.
You know what? Reverse in the market. Let's flip that logic now and look at the bearish logic. Sell-side liquidity exists below a low or a group of lows. That's when the stop losses of long traders are sitting along with sell stop orders from breakout traders. As price approaches this level, you'll usually see one, bullish traders protecting their longs. Two, breakout traders trying to force the break down. Smart money will once again engage in a trap, this time called a sell-side delivery, try to push down just enough to trigger all those stop losses and breakout shorts. Then, boom, they reverse the price upwards and go long, leaving retail traders stuck on the wrong side. The key takeaway, the market maker model is designed to hunt liquidity on both sides before moving price in the opposite direction. That's why it's so important not to chase breakouts blindly. Smart money isn't trading breakouts, they're creating them to trap retail traders. So instead of reacting to the breakout, wait for the liquidity sweep, identify the zone.
It's a fragile country. Today, man-made climate change is making hurricanes stronger and more frequent. Faced with this growing knowledge, these lizards' bodies are changing. Remarkable, over just a few generations, they've evolved larger tokens to help them
When smart money is likely to enter and then align your trades with the real momentum behind the market. Here's another key insight that can make a big difference in your trading. When price starts forming multiple support levels or internal structures just before it reaches a major demand zone, that actually increases the probability of a strong bounce from that zone. Let me explain why. As price moves down, creating point support along the way, more and more retail traders start buying, thinking the market has already bottomed out. But what do they all have in common? They take their stop losses right below each of those support levels. And that's exactly what smart money is looking for. See, if institutions want to buy, they need someone to sell. And those stop losses are essentially sell orders just waiting to be triggered. So when price finally hits that demand zone, all those custom stop losses get swept, creating a surge of sell-side liquidity. Smart money absorbs that selling pressure and steps in with large buy orders, causing a sharp bounce in the demand zone. This isn't random, it's engineered. And here's the real edge. If you see a liquidity grab pattern, like a stop hunt or wick spike, inside your supply or demand zone, that's a strong confirmation that a short-term market structure shift is about to happen. After that, price usually doesn't just reverse aimlessly, it starts moving directly towards the liquidity on the other side of the range.
Has Stephen calling there yet?
A little bit ago. Why, what's up?
Okay, can you, she wanna talk again about the chip, the problem.
Okay.
Ask yourself, is there stat liquidity leading into the zone? If we just sweep that liquidity with a clean action? If yes, that's your clue. Smart money just made its move and now you're trading on the right side of the market. Alright, now let's talk about something that sits at the core of every smart trade. Market direction. Or in simple terms, who's in control right now? Before we do anything else, the very first step in reading any chart is figuring out who's dominating the market. Is it the buyers, demand, or the sellers, supply? Because remember, we always want to trade with the flow of power, not against it. So how do we determine using control? It all comes down to mitigation. This is the key mechanism in smart money concepts. Here's how it works. When price comes down and mitigates the demand zone, that's the signal that demand is taking over, buyers are stepping in. On the flip side, when price moves up and mitigates the supply zone, supply is taking over and sellers are back in control. Let's say the market is in a clear uptrend. You'll notice a consistent pattern of higher highs and higher lows. Each time price pushes upwards and breaks market structure with inefficiency until price hits the next unmitigated demand zone. Now, this is where things get interesting. When price is stuck in a supply zone above and a demand zone below, we often see consolidation, a range-bound market. It's basically a tug of war, and whichever zone price breaks out of will show us who's in control next.
Stop paying those greedy telecom giants outrageous monthly bills. The era of being ripped off by monopoly.
So, if you're ever unsure what to do, zoom out and ask, has a zone been mitigated? Was there a chop or beam off, range structure? Which side is pushing price with more strength, demand or supply? This structure helps you trade with logic, not emotion. Alright, let's break this down step by step. In this example, we see 3 clear bullish moves, each breaking above the previous high. And this tells us that demand is in full control. Buyers are pushing price higher, and we even spot an unmitigated demand zone, meaning price hasn't come back to retest it yet. This zone becomes a key level to watch. When price falls back to it, we expect it to act as support. Then what happens? We get a short correction boom, another break of structure to the upside, this time with imbalance, which forms a new, even stronger demand area. As long as we might be entering a bearish reversal. Now let's mark the origin of this new downward move. The starting point of this drop becomes our new supply zone, and as price continues to break structure to the downside, that's confirmation. Supply is in control. From here, the market creates multiple, or it shouldn't be a temporary correction before the downtrend continues. And here's the final takeaway. We can't control what the market does next, but we can prepare for every possible scenario and let the chart tell us where to strike. Now let's dive into one of the most powerful tools in smart money trading, order blocks. Order blocks are not just random zones on your chart, they're defined supply and demand areas where large institutional orders were previously placed. In other words, this is where smart money made a move, and the market reacted strongly. Here's the key idea. When price hits these levels, it often gets rejected, and if price returns to that same level later on, there's a high chance it will react again. Why? Because there are likely pending buy or sell orders still sitting there, left behind by institutions who want to scale in or fill more of their positions. Now here's something really important. Every order block is a supply or demand zone, but not every supply or demand zone is an order block. Let me explain. Any strong reaction in price creates a supply or demand level. That simply means big players jumped in and pushed price hard in one direction. But if we traded every one of these zones, we'd end up with fluffy charts and a lot of losing trades. So how do we filter out the noise? Through experience and backtesting, we've learned that only some zones consistently deliver high probability setups. And that's where order blocks come in. These zones usually share a few specific characteristics that make them more reliable than standard existing zones. So before you start marking your charts, we need to know what makes a zone a valid order block. That's what we're covering next. I'll walk you through the exact criteria to identify a valid order block, and then show you how to draw them properly, so you're not just guessing where smart money is sitting. Let's break it down together, take things to the next level. A valid order block must break market structure. Let me explain. In a bullish scenario where price pushes above a previous high and closes strong, that move isn't random. It came from somewhere, and that somewhere is your demand zone, but not just any demand zone. That zone is now responsible for flipping the structure of the market. It's not just a level, it's a powerful decision point, showing that smart money stepped in and shifted control. The exact same idea applies in bearish setup. price breaks below a previous low and shifts the structure downwards, the supply zone that caused that drop becomes significant. That's where the big players sold hard enough to flip the market. So here's the key takeaway. A supply or demand zone becomes a valid order block if it causes a clear break in market structure. Without that structural break, it's just another zone, and likely not strong enough to start on its own. This is what separates ordinary levels from the true high probability zones that institutions use. These are the zones you want to watch, mark, and trade with confidence. Let's look at some real chart examples next, so you can see how this works in live price. Now let's take a look at this example. We're in a clear uptrend, and this right here is our most recent break of structure, which tells us that demand is still in control of the market. Each of these demand zones, they're all potential long opportunities. But here's where you need to start.
Oh my goodness. The person who invented this thing is simply a genius, because you only need to spread it once.
The origin of this bullish move, the exact zone where price launched and broke structure, is the one that deserves equal attention. That zone is where smart money enters the market. It's your high probability setup. Now sure, the other zones may still offer entry, but they carry more risk. Why? Because they're more likely to get swept in a liquidity grab, especially if retail traders are stuck in orders there. So what do? We adjust our risk management accordingly. Always remember, rate strategy grows your account, but risk management is what keeps you in the game. There's a solid rule of 60. Risk only 2 to 3% of your capital per trade, and you never have more than 3 open positions at the same time. This way, even if you take a few losses, you're not wiped out, and you're still in the game for the next high probability. Alright, let's talk about breaker blocks. One of the most misunderstood but powerful concepts in smart money trading. A breaker block is basically a sales order block that splits into the opposite. It turns a demand zone into supply, or a supply zone into demand. Think of it like this. You know how in classic price action, when price breaks above resistance, that level often becomes support, or when support breaks, it becomes resistance. The same logic applies here. Here's how it works. Sometimes a valid order block doesn't hold. Maybe the market structure has shifted, maybe price tapped into a stronger level on a higher time frame,
Hi.
or maybe it's just overbought or oversold. Whatever the reason, the order block fails, price
Making a video on my YouTube channel.
failed level. Now it's a breaker block, and guess what? It becomes an area where the opposite side takes control. Imagine price pushes up and breaks the recent high, leaving behind imbalance. This move creates a bullish order block, and naturally, we expect price to return and react. But here's the twist. Instead of bouncing, price reacts to it. Boom, you get a change of character. Chop, chop. Price breaks below the previous low with aggression, confirming that sellers are now in control. That failed demand zone, it's no longer demand, it's now supply. This is our break block. Why does this level often work so well? Because traders who went long at the original order block are now trapped. When price returns, they want to close at break even. At the same time, smart money sees this as a fresh supply zone and start shorting. So now, we've got trapped buyers exiting and fresh sellers entering, and that's what causes price to reverse hard in this zone. Let's wrap up with one of the most important concepts in trading, market structure. So what exactly is market structure? Think of it as the backbone of price action. It includes the swing highs and swing lows by demand zones and the overall flow of the market, also known as order flow. Now the market usually behaves in 2 main ways, trending or ranging. In a trending market, price moves in one dominant direction, either up or down. Let's focus on an uptrend. In an uptrend, price pushes upwards, forming a sequence of
Yes.
higher highs and higher lows. This pattern shows that buyers are in control and momentum is driving the market higher. Take a look at this classic bullish structure. Price keeps respecting previous lows and breaking new highs. And this is what we call an ideal ascending